latest understanding is that there's no legislative change required, but there is going to be a letter of Treasury to give permission. The MLP structure definitely requires legislative change. That's why I don't think it's politically viable at all. Everything else is not only legal, but like a lot of the infrastructure is already there. And it's kind of only a matter of kind of getting the markets accustomed to it. And it, you know, bonds, you need to kind of have a big enough project and a safe enough project. You know, Topaz, the Topaz is kind of like the most famous bond financing, backed by Buffett, $850 million bond issuance, and it still was just a triple B rated. So I think it's just a matter of markets getting comfortable with it. Paul.
Michelle, yeah, this morning we heard we have to shrink the cost of transactions to get down to the desired cost of power. I see low cost of equity here, but overall transaction cost, is this reasonable?
Yeah, the transaction costs are no doubt more expensive than they would be in a feed-in tariff market. I'll put it that way. And not just more expensive, but like there's some threshold where banks just don't care. I mean, if the kind of the total fund size you're talking about is not north of $30 million, no one cares. No one's going to be interested in putting together tax equity structures to make this even viable. It does not worth it for the rating agencies to be kind of looking at, you know, rating the bonds or the securitization. So there's those kinds of thresholds, and then there's definitely kind of transaction costs. That said, there's definitely kind of movement to move down on the tax equity yield. So there's movement for those transaction costs to go down. Yeah. I'm sorry, I don't know your name.
Janet, can you comment on your thoughts on IDAs getting into the business of financing local industrial development authorities? It's another hot topic among the IDAs.
And what role would where would they come in?
Float bonds.
Okay. No, this is I haven't heard too much about that. Yeah. Sounds good. Charles.
Yeah, I just wanted to follow up on that. Is it that could address that 20% equity that's expensive?
Yeah.
The question is there a way of getting? It's probably harder at the federal level than at the state level.
Yeah, to kind of be some of the, maybe kind of be providing some of that, or at least some support around the equity to lower those costs.
Yeah, 50% match.
Let me do this. Let me just push forward if that's okay, because I want to make sure we have enough time to discuss the panel, and I have a couple more provocative comments that I want to make, and hopefully piss some people off. So this is what the tax equity kind of landscape looks like. You know, what's interesting to talk about is first of all, there's such few players in tax equity. Basically, anyone who faces corporate tax obligations could be providing tax equity, but basically kind of look at how essentially kind of how scarce the base is. This is a pretty exhaustive list, by the way. It's nearly exhaustive list of who's doing tax equity. And this is what the yields look like. You know, look at tax equity yields, which are the lines, and compare it to the cost of debt. You know, effectively, if you had a market like a feed-in tariff market, or a market where you didn't require tax equity, your total kind of weighted average cost of capital would be much, much lower because these yields are relatively high. And there's various reasons why those yields are high. I'm happy to speak about that. I want to talk very quickly about prices, module prices, costs, and the economics, and wrap it up with that. Module prices, everyone's aware, have fallen significantly. We've talked about that already. And what that's done is it's made it a very, very kind of competitive marketplace, at least when we're talking about utility scale PPAs. Look at these PPAs in California. Historic prices, relative to kind of the target rate of return. This is effectively kind of, there's bids right now for 2016 delivery aiming at something like $70 per megawatt hour, which is roughly in line with what we think will be a 10 or 20% return in 2016, given our projections for where module prices are going. So these are very, very aggressive bids, kind of looking out to 2016. This is getting close to the aspiration that the DOE is talking about. But remember, this is utility scale. This is the California marketplace. This is extremely, extremely, extremely competitive. As opposed to, look at these essentially kind of California residential market compared to the German market and compared to the Japanese residential market. This is not competitive. And I'm going to say something kind of very controversial, which is that, yes, our costs might be slightly higher than they are in Germany, but the fact that you're seeing $5 and $6 prices in California has nothing to do with costs. Could it possibly be that someone's making a lot of money? I mean, look at what's happened with module prices, and look what's happened with the German prices, because the German prices effectively follow the feed-in tariff. The feed-in tariff falls with the module price. But because the California system doesn't fall with the module prices, because you have the California Solar Initiative, you have the investment tax credit, you have other rebates out there, these prices do not reflect costs. They reflect value. That's why California prices are $6 per watt. And And the developers in California will contest this and say, actually, that the people are underestimating their costs, and that well might be the case, but I'm sure they're making a lot of margin. And now I just kind of want to wrap it up with the SREC picture, which is the other side of the country. We talked about California. This is the Massachusetts solar rec price forecasts. Massachusetts, absolutely fascinating. It's the most complicated market to figure out. A lot of developers are terrified about it. But the day you figure it out, it's actually the most predictable market out there. We basically guarantee the prices will be in the kind of $450 per megawatt hour range in the 2016 period. We've run every single possible scenario to test that out. And it's because of the nature of how essentially kind of the carve-out works in Massachusetts, which looks back at past shortages or excesses. And so these SREC price forecasts are actually very attractive to developers. The problem is that developers can't get financing off this because banks don't believe these forecasts. And so if banks believe these forecasts, you could basically kind of put together a project. These are the returns you could get. But actually no one gets these returns because no one is willing to run with these risks.
That's not true. We arbitrage, we had facilities that arbitrage 10 years in Massachusetts at 19 cents, which is not a lot of money, but if you add in, okay, 6 cents, KWH price, we're sitting at 25 cents. Even though it may be going at 5.60, we can arbitrage, and a 5-year arbitrage is 26 cents. So that is out there.
That is out. Okay, so there's players who are willing to kind of be
right. Who make a lot of money.
Exactly. Fair enough. Well put. So let me close it up here. Yeah, and I know I've talked a lot of. Yeah.
No, I think everybody, now that everyone is on an absolute equal plane in terms of finance, I guess the rest of the panelists can go up and then we could talk about more detailed finance and differential equations and all that kind of stuff. So what we really want to address here is just come up with some high priority approaches to mitigate the risks that are out there now. I mean, it always seems to me that the risk premium should be lower. Because you look at a solar system, it can be built very quickly, very durable, no moving parts, but there's some risk out there, and there's a perceived risk. I myself think that just a matter of time, when people become more familiar and more comfortable, it'll all start sliding down that curve, as Michelle had pointed out. But I'll leave it up to the panel here to come up with some other thoughts here and to correct me or agree as to why they think there's this risk premium and how do we best address it. So anyone who wants to speak, feel free. On both sides, by the way.
Well, I'll take a shot at the initial comments around the risk premium as it relates to evaluating the technology and evaluating a particular project. Our role is to, depending on who hires us, in many cases who hires us are the people who are both on either side of the table. It's the sellers and the buyers. And when we're looking, and when we're representing the buyers, we're looking at where are the risks, what are the fatal flaws, what are the things that they need to consider from a technical evaluation. So are all the permits there, are the land acquisition rights there, is the PPA in place, what equipment is in place, are the supply agreements in place, and it really does depend on the size and the scale of the projects. And things have changed significantly in the last several years that we've gotten more involved in this. About 4 years ago, 5 years ago, when we first started working on this, and to Peter's point, it is time. 4 or 5 years ago, First Solar was not really considered bankable because they didn't have enough equipment out there, they didn't have the same track record, and now First Solar is generally in the same conversations as other companies who have the 10 and 15-year track record. So part of it does come down to track record. Many of the companies in the solar industry don't have that 30-year, 25-year, 30-year experience. So how has that been evaluated? How has the
are the regional test centers? How are some of those accelerated tests evaluating the real life and the actual performance scenarios for the particular project? So there's a number of things that are coming into play. The downside of the traditional energy, be it coal, be it natural gas, is that it has been established for 30 to 50 years, and it does have that track record. So you're going up against traditional energy that isn't quite as scary to somebody who's looking at how do they have a lower cost of equity, a lower cost of debt. The premium is that track record and technology.
What I'll add to that a little bit is that from our perspective, Monolith we're the local guys. What a lot of you guys are talking about right now is federal policy, maybe state policy. And I see some graphs up here talking